You were thinking about buying your first home. One of the first questions is often, how much do I qualify for? But it's important to understand that you are the one who needs to first answer, how much can I afford? You need to keep in mind that mortgage lending has requirements to determine what loan you are eligible for. But I want to look at your big picture to see what is the most suitable to your needs. Where you really need to start is with a budget. To get started, lay out your income and expenses as precisely as possible. For the loan, we will use gross income to qualify you, but you will want a budget using take-home pay. Next, think about your discretionary spending. What are expenses you do not want to cut out? Is it important to send your kids to private school? For me, I always had to factor in the cost of owning horses. Also, look at what expenses you could cut out to save money. Perhaps you could start taking your lunch to work. Be sure to check old statements for subscriptions you are paying for but not using. And of course, you'll want to plan for what your new expenses will be as a homeowner. I have a number of budgeting tools, so please reach out for more information. While you are putting your numbers together, go ahead and gather the documents we'll need to get you pre-approved. We'll detail those in just a bit. It's important to understand what makes up a mortgage payment. First is principal, which is the amount you borrowed that is getting paid back. The principal balance is what the interest payment is being calculated on. Interest is calculated as a percentage of the loan balance. A mortgage loan has an amortization schedule for the period of the loan so that your combined principal and interest payment stays the same each month. In the beginning, the bulk of the payment you make goes to interest. A temporary buy-down can be used to help lower this cost for the first 1 to 3 years of the loan. Property taxes are based on the value of the property, as determined by the county and possibly the city as well. This amount will most likely change each year, and the lender will adjust your payment accordingly. Homeowners insurance is mandatory, but this is something you are responsible for shopping for. The lender will have certain coverage requirements. This is another cost that could increase each year. If mortgage insurance is required and how much it will cost will depend on the loan program and how much you put down. In a later series, we'll dive into the different types of loans. You'll get the best estimate of these expenses when we go through the pre-approval process. As a homeowner, there are other expenses to consider. Some properties require you to pay dues to the homeowners association. These will be used for items like maintenance of common areas. You are required to pay them and can lose your property to a lien for failure to do so. If you purchase a condo, there will be additional fees involved. Fees can range as high as $400 a month, so be sure to work with a realtor who can help you navigate what different properties will require. As a renter, you may already be paying for utilities, but keep in mind they can vary a good deal based on the type of heating, construction of the home, etc. There is a lot to think about in the maintenance category. If it's a property with a yard, what equipment are you going to need? If you are worried about the cost of repairs, you may want to consider a home warranty. Now that you understand your numbers, it's time to meet so we can get you pre-approved and discuss your most suitable loan options. We'll start with an application and authorization to pull credit. There will be a deep dive on income, credit, and liabilities to assess your eligibility. Income can get complicated depending on how you are paid and how long you have been employed. We'll generally want a 2-year history, but schooling time can count, which will usually require transcripts to show dates of enrollment. I'll walk you through everything you need to know for your situation. Credit is a major area that will be reviewed by a lender, and your credit score will have a significant impact on if you qualify for a home loan, what type of loan you will qualify for, and what the loan will cost you. To understand credit scores more, or if you have challenge credit, there's a video in the CALM course that deep dives on credit, or you can reach out to me to discuss your situation. The lender is going to consider all debt showing on your credit report. Certain debts like student loans and medical collections are handled differently depending on the loan program. It's extremely important to disclose upfront any financial obligations you have that will not show on credit report, like child support or alimony. When the underwriter does their due diligence, they will uncover these obligations, and you don't want to be sidelined once you are into the process. Using the information gathered on your income and liabilities, your ratio will be determined. Ratios are formulas used by lenders to evaluate your ability to repay a mortgage. The first is your housing or front-end ratio, which is the monthly cost of the home itself divided by your monthly gross income. In addition to principal, interest, taxes, and both homeowners insurance and any required mortgage insurance, they will also factor in any HOA or condo dues as well. During a pre-approval, we're guessing at some of these numbers because they will ultimately be property specific. It's important to keep me in the loop as you're shopping to see how those costs could fluctuate. For instance, if you're looking at a single-family home, but then decide on a condo with dues of $250 a month, it's going to affect your ratios. Next is the debt-to-income or back-end ratio. This is all of the expenses in the first, plus all of the other liabilities the lender will consider. Your ratios will have an impact on the loan you qualify for and will be used to determine your maximum loan amount. So far, we've talked about monthly costs, but we also need to think about what you may need up front. There are various closing costs that are part of a home loan. Reach out and I'll be happy to send you a booklet that details these charges. But to give you an idea, there will be an appraisal that the lender will order that you will pay for. Do not confuse this with the home inspection. The appraisal is to determine market value. A home inspection your realtor will help you set up, and that is for your peace of mind to better understand the condition of the property you're buying. A fee for the credit report. Cost to set up an impound account, also known as an escrow account. The lender will collect taxes and insurance as part of your monthly payment, and then pay these costs out of the impound account when they come due. At closing, the account gets pre-funded. Loan discount points can be paid to buy down to a certain interest rate. Discount points buy down the rate for the life of the loan and should not be confused with temporary buy downs. The origination fee covers the lender's cost for originating the loan. A title company plays a large role in a home purchase. They do the research to discover any liens the property is subject to. In most cases, part of these costs are shared by the seller. Interest will be collected from the date you close until the end of that month. If you close earlier in the month, there will be a larger charge here. The first year's homeowner's insurance premium will be collected at closing. In Montana, our taxes are collected in arrears, so you will generally receive a credit from the seller towards the taxes that will come due. Seller credits can be used to offset any of these closing costs. In addition to the closing costs, you may also need down payment funds. Different programs have different maximum allowed loan to value. On a purchase, the loan to value is determined by dividing how much you are borrowing by how much you are buying the property for. However, if the appraisal comes in lower than the market value, that is the market value the lender will use. Depending on how your purchase contract is written, that is generally an area to renegotiate purchase price with the seller. There are loan programs that allow you to borrow the full purchase price, and you may also be able to get down payment assistance to help in this area. Again, the amount you will need to put down will depend on the loan and can be affected by factors like credit score. If you do need down payment funds, there are options. If you have a family member willing to help out, they can gift funds to be used for your purchase. We'll talk about a program to kickstart that in a minute. For qualified borrowers, there are grants which do not have to be repaid. You can get a down payment assistance loan, which will be a second mortgage that can help you cover down payment costs and closing costs. Deferred loans are also second mortgages, but they only need to be repaid once you move, sell, or refinance. And then there are forgivable loans that do not need to be repaid as long as you stay in your home for a certain period of time. At CMG, we have a program called Home Fund It. Traditional gift funds need to come from a family member, but using the Home Fund It platform, you can receive funds from anyone. This can be especially helpful if you know there's an event coming up in your life, like a wedding or a graduation, where a lot of people would like to help you out. Not only does the platform make it easier for people to give and for you to receive the funds, but CMG offers a match of $2 for every dollar gifted, up to $2,000. It's very important to keep in mind that any funds you are using will need to be documented, so be sure to plan accordingly. Traditional gift funds will require documentation from the gift giver as well as proof of receipt. For personal funds, you are usually required to provide 2 months of bank statements. Keep in mind, any large non-payroll deposits will need to be sourced, meaning documentation will need to be provided to show where the funds came from. Try to avoid transferring money back and forth between accounts. When you put an offer in on a home, you will generally provide earnest money. The lender will require a copy of the check dues as well as bank statements showing the funds cleared the account. Beware of using cash for earnest money or making cash deposits. Those funds are better used to purchase items you will need for the home. Once we have you pre-approved, it's time for the fun part and you can go shopping. Until the contract is signed and the loan is closed, however, it's critical to keep some things in mind. Stay on top of all your bills. Don't make any major purchases, large deposits you can't document, change jobs, etc. With that being said, life happens. So if you do have a change in circumstance, just be sure to keep me posted so we can adjust accordingly. You can continue to use credit cards as you have been, but beware of making large purchases. You will be pre-approved based off of the numbers on your credit report, but those are updated prior to closing, and if the monthly payment has gone up, it could negatively impact your loan. I understand you're going to want to buy things for the house, but best to wait until after the loan is closed before incurring any new debt, no matter how enticing the furniture store is making their new cards seem. Once you've done your budgeting, know your options, and we have you pre-approved, it's time to start shopping. If you have questions, please reach out to me. Next steps are outlined in First Home Part 2.